So understanding all aspects of this business is super important so you guys can do a great job and deliver the right information, setting expectations. So mortgage basics, a couple of the mortgage programs that we're going to go through today, or you have your conforming. Your conforming conventional loan is just your standard FHA, not FHA, Fannie Mae, Freddie Mac conventional loan. You have non-conforming, and what's considered a non-conforming is anything that is not a government-backed security. So that would be your jumbo loan. Does anybody know what jumbo loan limits are or what the conforming loan limits are before you go to jumbo? No, nobody's raising their hand. All right, it's $510,300. If you have a loan amount over that amount of money, then it is going to be a jumbo loan. It's going to be a lot harder loan to get. It's going to be scrutinized. The interest rates sometimes are a little bit more than it is on a conforming, but it's because investors are backing that loan. It is not a mortgage-backed security. So the guidelines are totally different. When COVID started, the jumbo market totally dried up. So if you were in the California area and you were doing mortgage loans, you were having a really hard time with anybody that had houses for sale in that jumbo market, and you were having a really hard time if you were trying to help people buy homes in that jumbo market. The jumbo market has started to come back. It's not back like it was prior to COVID. So fortunately for you guys, we don't have that many $1 million houses around here. Then you've got your FHA loan, but back up. Non-conforming is also a USDA loan. USDA loans are not backed by HUD, they're not backed by the VA, they're not backed by Fannie, Freddie, mortgage-backed securities. USDA is another entity of its own. VA and FHA. So those are the areas that we're going to cover. Write this down so you understand. Down payment. I know that you guys, down payment is the part of the purchase price of the property that the buyer pays in cash and does not finance with a mortgage. But please know, this is the part I need you guys to understand. If that house is short value, you've got a contract on a $200,000 house, and the value comes back at $195,000. Mortgage down payment is going to be based on the lesser of the sales price or the appraised value. So now all of a sudden our loan is based on the $195,000. We're going to loan 95% of that, and they're going to have to pay that difference between the appraised value and the sales price if that was agreed to. Now, one thing that I'm starting to see in contracts, I have a contract in the pipeline right now. It's a property in San Antonio. It was multiple offers. The seller was concerned because the bidding got up over list price. The seller was concerned that the buyer who agreed to pay over list price would back out if the house didn't appraise. So if you guys are listing a property that's top of its market and you end up in that situation, you can ask for additional documentation, and I'm not giving you legal advice, so you talk to your broker on how they want you to document it, but you can document saying that the buyer is willing to pay the difference if the value comes in low and specify the dollar amount. That way your seller's not in a situation where they agreed to this higher contract sales price over list more than you're comfortable with because you've already ran your comps when you listed the property, and now the value comes in low and your seller is in a bad situation. Debt to income. That debt to income calculation that we use is the monthly payment as it relates to the monthly income. So we literally the debt to income requirements are different for every loan program. Debt to income requirements are also determine the mortgage premium that they're going to pay for the mortgage insurance. Debt to income has everything to do with the loan. Most of the time, a loan will be, most of the time when I get a loan from another lender that has not, the lender wasn't able to get the loan done. When I look at the income was calculated incorrectly. And because the income was calculated incorrectly, the debt to income was incorrect. And that's why the loan is typically declined, which is why we as a company require income documents upfront before we ever do a pre-approval letter, because the income will make or break a transaction. And then you have your reserves. So that's the other common term that you'll hear. There are times literally that we cannot get someone's loan pre-approved because they don't have enough reserves. So reserves is the money left over after they write their check for the closing costs, down payment, taxes, and insurance. They still have to have some money left. And then the credit score obviously is a term that we are looking at all the time. Now, please know and understand, we use FICO. FICO credit scoring system is the scoring system that was adopted in BJ, let's see, that was, I was really new to the business when we started FICO, and that was in 97 or 98, I think.
Right.
Before that, we just went straight off of credit history. Then FICO became the score that we all had to look at. The only thing that is confusing about the scoring, credit scoring system is every entity, every company, they all use a different scoring system. So it's just like going to one school versus another. They are going to grade the information differently based on the criteria they've set. But for you, mortgage companies all use the same version of FICO. So when a customer comes to us, we always ask them, hey, what do you think your credit score is? They tell us what their credit score is. So say they say 680. Fantastic, that's a great score. Now, when I pull a credit report, chances are it's gonna be a little bit different. What scoring system are you using? And if it's, you know, the consumer credit score, we can pretty much predict that the score is going to be 20 to 30%, points less when we pull it than it is on the consumer score. And it's just the way the information is calculated. So your client may get really frustrated because they go, my credit score is 680. And now the mortgage company is telling me my credit score is 640 or 650. That's why, because it's a different grading system. Another part, you guys will see annual percentage rate, or the APR. Your APR is different than the interest rate. It's always going to be higher than the interest rate, and I can explain more of that later, but for the sake of time, I won't go into great details. Closing cost, a lot of times you guys will say, hey, how much of the buyer's closing cost does the seller need to pay? Well, that's a generic term. A lot of times you guys say closing costs, and what you mean is their out-of-pocket expense. Closing cost truly is the items paid at closing to include the non-recurring items and prepaids. So closing costs is all those third-party fees, all of those vendor fees that are necessary in order to facilitate the transaction. So each loan program has a specific percentage that they will allow the seller to pay. So it's really important that you guys always know and understand what that is based on loan program. And we're going to go over that in just a few minutes. Yeah.
Oh, sorry. Are you trying to show us a document or something? Or
No, but if you want to see it, if that holds your attention better, yeah.
It kind of does. I apologize. So.
Hey, you know what? I was trying something new, and I was waiting to see who was going to give me any feedback on that. So glad you spoke up. Okay, so you see it?
Yes, ma'am.
I know what you're doing. You're doing screenshots so you don't have to take notes.
A little bit of both. Yep. Thank you.
I love it. All right. So then your seller concessions. You guys need to be very careful about your seller concessions because, again, the loan program will determine how much the seller can pay. Oftentimes I get that phone call, hey, I just received a contract, and they're asking the seller to pay, you know, $7,000 of the buyer's closing costs, but it's a conventional loan and the sales price is $150. Is that really possible? Well, that's when I go, ding, ding, ding. We have a realtor who's been paying attention, because no, that is not possible if they're only putting 3% down. So knowing this information is super important. So we're going to start with VA loans. I love VA loans for a lot of different reasons. VA has got its quirks, but we totally understand VA loans and do a ton of them. So we are not scared of that VA loan. One thing I want to tell you guys is there are some mortgage companies out there that will post themselves on the internet as being the VA lender. And the veterans will feel so strongly that this website or these mortgage companies are the legit VA lender that they feel like they have to use this lender. And all this lender is a internet generating lender. So what they do is they have a big web presence. They promote themselves as the VA official lender. People apply, and then they sell those leads to realtors who then are paying back to that mortgage company a portion of the proceeds when that loan closes. So the veteran thinks that they're getting this fantastic deal. They're really paying more in closing costs and typically a higher interest rate because they're using the official veterans lender. So just be really mindful of that, because I see that happen a whole lot. Typically, it is best for them to go ahead and get a second opinion from someone local, because they aren't getting the deal they think that they're getting. But people prey on the veterans just like they prey on senior citizens. It's sad, but it happens. And drives me crazy. Your VA guidelines are a little bit easier than your conventional loan guidelines. So even if you've got a veteran that's putting a big down payment, and you'd be like, why are they going VA and putting a big down payment? Well, it may be because of the underwriting flexibility. So VA loans right now, during COVID, right now, we're at 600 as a credit score requirement. That is not a VA credit score requirement. That changes from lender to lender, and it's based on the lender's tolerance for the risk. So for us, we're comfortable going down to a 600 credit score. A lot of lenders are at 660, some are at 680. Occasionally you'll see someone that'll go down to a 640 credit score. We're okay down to 600. And the reason is because we service our own loans, so that we have a pretty good idea what loans and what credit score groups are performing on their loans. The debt to income ratio that VA is looking for is typically 42%, but they have some other calculations that we have to use as well, called residual income. So it's not quite as simple as, they're fine, they're at 42%. There are compensating factors that we can use if someone does have higher debt to income, which is another reason we like to use VA. Now, please know that VA loans are only for your owner occupied. You can't do a VA loan for grandma to live in a house. And you can't use a VA loan as investment property. You can't use a VA loan for a second home at the lake. It is for owner occupied only. VA does not have monthly mortgage insurance, but they do have a funding fee that they charge the veteran. And it's a pretty hefty fee. So a lot of times that catches the veterans off guard because they're not expecting that fee. That is not a lender fee. It goes straight to VA. That's what VA uses to cover any imbalances in their foreclosures. Escrows, just so you know, when they go to closing, taxes and insurance has to be included in their payment. It's just the way the VA has their loan set up. We always have to have an appraisal on VA. And you can do a VA loan as a fixed rate mortgage, or you can do an ARM. Right now, we're not really quoting any ARMs because the fixed rates are so stinking low. But when rates go up, we'll look at ARMs, especially if someone knows for sure they're not going to be in the house for very long. The maximum loan limit has just gone up in the recent months. It is now at $510,300. However, VA does have a jumbo loan product that is way easier to get approved than a regular jumbo. So a lot of times we'll take our veterans jumbo if someone needs to be in that jumbo market. I don't know, have any of you guys ever attended the Texas Veterans Land Board CE class? They do a 2-hour CE. No? It is a fantastic program. If you guys, I'll get him back to town whenever we're able to have live trainings again, because the Texas Veterans Land Board has some amazing programs available that you can utilize. They even have 90% land loans for our veterans, and they have a list of land that is available for the veterans to purchase. So it's a pretty cool program. We do those loans. So if you have any questions or have anybody that has questions about it, send them our way. Now, seller concessions can be a little tricky on VA. So I'm going to just tell you this, so you don't have to remember the formula and how it's calculated. Your VA or the seller on the veteran's behalf can pay up to 4% of the sales price or the appraised value, whichever is less, towards the buyer's closing cost, plus the VA non-allowables, as long as the VA non-allowables do not exceed 1% of the loan amount. So it can get really tricky. What I'm going to tell you is if you have a VA transaction and you've got seller concessions and the sales price is under $200,000, you're on the buyer side, the seller side, and they're using another lender somewhere else, I don't care. Text me and I'll tell you if the seller concessions is right or wrong. Because I don't want you guys to set some unrealistic expectations for buyers and sellers, and it is pretty confusing to know and understand how those numbers need to be. So keep my cell number handy. You guys need to know my cell number is handy for you guys to use. Your clients just need to call the office so that the team can take great care of them, but that leaves me available to take care of you guys and answer all of these questions so that you guys know what to do as you're going along on these transactions. I feel that way about any transaction, whether I'm a lender or not. If you guys have loan program questions, the loan program guidelines are pretty much the same from lender to lender. There is some variation from lender to lender on their tolerance on risk, but for the most part, I can speak on most people's behalf, or I can for sure speak on our behalf. I just want to be that person that you guys go to whenever you have those questions, so you don't get into the middle of a transaction that just falls apart over something silly. The one thing that I did want to bring to your attention is anything of value is considered a concession. So if you guys have a non-realty addendum as part of the contract, and you're leaving behind the entire house, Chip and Joanne Gaines came through the house and decorated and have all of this furniture, and you put in there that the seller is leaving behind $20,000 worth of decorating and furniture, that's going to be considered a concession, and it's going to be a problem. So that's why a lot of times you'll have lenders that say, hey, don't put all of that stuff on the addendum. The seller can have a garage sale and the buyer can go buy this stuff from a garage sale. But at the same time, if they're using money for all of these items, of course, the lender is going to be super nosy and want to know where their money was spent and how they came up with the money that they spent it. So open lines of communication is super important during a transaction. Here is the chart that explains what that fee is. So if they've never used a VA loan before, then that fee is going to be 2.3%. If they've used a VA loan before, it's 3.6%. Now, and then if they have a larger down payment, then the funding fee is reduced, and here's the chart for that. Let's back up though. When someone says, hey, I want to do a VA loan, we'll ask for their DD-214, which is their discharge papers, or if they're active, we'll ask for additional, or their active papers. We have to get a certificate of eligibility to show how much they're eligible for. Typically, we can get that online within, a couple of hours, if not immediately. Sometimes it takes 24 to 48 hours if we need additional documentation. That documentation would be, hey, they have a loan that still shows that they owe the VA, but they haven't paid it yet, or they don't have proof that it's been paid off. The other thing that's a little bit quirky about VA, if you have a veteran that is selling a house and they have a VA loan on it and they're buying a new house simultaneously, some lenders will not do a simultaneous transfer of the eligibility. So that would mean that the seller would have to sell the house, prove to the VA that they paid the house off, then they can buy a new home, and that can sometimes take days or weeks. Guild takes we go ahead and allow that transaction to close as long as we feel secure that the seller is paying that house off, and we have a copy of the closing disclosure showing that it's closed and funded, and it's just a matter of time. And then we'll do all of the legwork on the back end to make sure that we're good on that end. Not all lenders will do that, so you guys need to be aware of Another thing that I want to make sure, two more things on VA while we are on that subject. Sometimes your veteran has disability that qualifies them for a reduction or no property tax. As a lender, it is lender's discretion whether or not they're going to set up the loan and require that they make their payments with the property taxes and then prove after the fact that they do not owe property taxes. On a case by case, we may be able to close the loan without the property taxes as long as the veteran can go to the appraisal district and get something in writing stating that they do not have to pay property tax. But we are doing that based on our trust that the customer will go file the paperwork after they are in ownership of the house because they can't do it prior to. So again, it's a case by case. We can make that exception. Not all lenders can do that. So you need to be prepared for that. The reverse can be true. If you're selling a house and the veteran does not owe property tax, the buyer is not does not have any disabilities, and they will owe property tax. If you do not set up your tax prorations correctly, your buyer, your veteran, your seller, it does not owe any property taxes. Your seller is going to then, your buyer is potentially going to owe a year's worth of property taxes, and they're not going to get a tax proration from the seller. So y'all need to be paying attention on every transaction. What is the property tax for the seller? What exemptions did the seller have? And how does that affect my buyer? If you don't know the answers to those questions, you need to ask, because you could end up at the closing table. We as a lender are watching that, but not all lenders are watching that on the front end. So if I tell a customer, hey, you're going to need $15,000 for this transaction at closing, and then I'm not paying attention and I don't notice that the seller is not going to pay any tax prorations, and now all of a sudden they owe more at closing, they're really upset. So those are just more of those gotchas that you've got to pay a lot of attention to. Again, ask questions if you have questions, because I would rather you guys set those expectations for the buyer and the seller. And that's true on any loan program, cash transaction, bank transaction, any of your transactions. You need to pay attention to the taxes, the property taxes and the exemptions, and make sure your prorations are going to be based on what the buyer and the seller was expecting. FHA, any other questions on VA? You can have 2 VA transactions at one time. It is called subsequent use. There is a formula, there's a worksheet that we have to use, and the down payment will be determined by the information on that worksheet. It's not always a 0% down on the second transaction if they're retaining a VA loan. So again, that's all the information that we've got to calculate whenever we're doing a pre-approval. When we get done with this, you guys will totally understand why it takes us 24 to 48 hours to thoroughly pre-approve someone, and why we don't just kick out a letter just because you said, hey, we're making an offer, can you send me a pre-approval letter? No, I cannot, because I've got to pre-underwrite that file to make sure you're protected when you go to the closing table. All right, FHA. Credit score requirements are the same on FHA as they are on VA. Right now we're at 600. Debt to income calculations are calculated a little bit different on VA versus FHA, and I won't get into the weeds on how that is different. Just know it's pretty darn different. VA has its own set of guidelines, and they're pretty quirky. There is a max loan limit by county. So if you guys are looking at houses in Solana versus Gunner, there is going to be an FHA credit limit, not credit limit, loan limit that is different because it's 2 different counties. So you need to be aware of what those loan limits are, and you can Google and pull those up. It is based on the loan limit. So if you're purchasing a home that's $450,000 in Solana, and they're putting enough money down that they're below the limit, that's fine. It's not based on sales price. There are some credit criteria that is way different on VA than it is on FHA. Same thing from FHA to conventional. They're all different in their credit world. We're not just looking at credit score. There's tons of information on that credit report that we have to analyze every time we pull a credit report. Down payment requirements on FHA is 3.5%. Gifts are allowed on all loan programs now, but the gift requirements on VA and FHA are drastically different than they are on a conventional loan. So this is what you need to know about that. When you have funds that are coming from mom and dad in order for the kids to purchase the home, we are going to not only have to have a gift letter signed by mom and dad, we are also going to have mom and dad's bank statements. That's a toughie. Mom and dad do not want to give up their bank statements. They are not on the loan. So that conversation needs to be had up front to set those expectations. We seriously have one transaction going right now within the company. I was one of my coaching clients was like, how do you reply to this? You know, it was a really ugly email from a mom who was just raving mad because we were asking for bank statements. So please, that is a conversation we need to have up front. We are always asking people where their funds for closing are coming from because we want to have those conversations sooner rather than later. Just FHA, the one thing I want to make sure that you guys know and understand on this slide is that FHA, again, like VA, is owner occupied. You cannot use it for investment property. You can't use it for second home. You can't use it for your kids to live in. You can't well, you kind of sort of can if you put the kids on the loan, even if they don't qualify. If the kids are going to be living in the house, we'll just, there's some ways we can get around it. With VA, we can't. So, any questions on that slide?
What's the max amount for gift funds that can be given?
They can give them 100%.
Okay.
Like even Alex, there's some times where people have to pay off debt in order to qualify for the house, and mom and dad can even give them the gift funds to pay off the debt to qualify.
Okay.
So yeah, there's not a limit anymore, so that's pretty cool. With FHA, the one thing that I want you to know from this slide is that the mortgage insurance that they pay, which is based on the amount of equity that they have in the transaction, is going to be on there for the life of the loan. Okay. So that is something that everybody needs to be aware of. All right. Now I have a flyer that we will make sure that you guys have. Will the property pass FHA? Because that's a question that I get asked often. So you will have this flyer. So whenever you guys are going to go list a house that is in the FHA price range, I would highly recommend when you're listing that house that you use this as a checklist to make sure that the house is going to qualify for FHA before you put it in the MLS and say that it does. This applies basically to a VA too. The guidelines are real similar. So if you use both this, if you use this flyer or this checklist for FHA and VA and USDA, you should be pretty safe. Please know and understand any lender required repairs is the appraiser's discretion. So I can't tell you for sure whether or not something is going to be a problem. Oftentimes I will get a text message that says, with a picture that says, hey, do you think this is going to be a problem with FHA? If I'm not sure, I will send it to, I'll just do a group text with a couple of my appraisers that we often work with and just say, hey, what do you think about this? And I'll give you the feedback. But please know and understand that when the appraiser shows up, it is possible that they'll have a different opinion. You'll just have an idea whether or not it'll work. FHA and conventional loans, we have to order the appraisals through appraisal management system. That's a third-party system that round robin orders the appraisals. I don't have any control over who is going to be assigned to the appraisal. However, we have a list of our tried and true appraisers that we've had relationships with for a long time. And the relationships are beneficial because I know that we can trust them to deliver the work when they say that they will, and they also communicate with us. I can't, a good appraiser is not someone that just brings in the values where I want them to be. That's not their job. VA has their own separate system that they use for their appraisals. And when the appraisal comes back, it goes straight to the underwriter. The underwriter the underwriter approves the appraisal or issues a letter, a commitment of value, and then, or notice of value, then we can proceed with underwriting the rest of the file and getting everything clear and releasing that appraisal. So just a little bit of difference between those two. Seller concessions on FHA cannot exceed the actual closing cost and prepaid. So the seller cannot pay the buyer's down payments, but they can pay all of the closing costs and prepaids, which could include taxes and insurance. Just again, keep in mind that seller concessions can also include any repairs that were required. My underwriter, we had a discussion not long ago about this scenario, and if the repairs are required, there's some leniency. If the repairs that are being made are just because the buyer wanted them done and they're not necessary for the transaction, then that could be considered a concession. So a concession is anything that the seller is giving a value in order to give an incentive to the buyer to purchase. That's the interpretation of a concession. All right, any questions on FHA? The other thing, so one thing I did want to make a point of, when you do an FHA appraisal, a case number is issued for that property. When the appraisal is returned, it is logged into HUD's system with that case number on that property. That appraisal stays with that property for, I can't remember, I think it's 6 months period of time. Can't remember exactly, but I can get back to you on that. The reason that I say that is because it is super important that you, if you are the seller's agent, that you know who the lender is and you trust who they work with on the appraisal side, especially if you feel like you have priced the house at the top of the market. Because you get a bad appraisal on FHA and it's a $150,000 house and the deal bust, then because the value came in low or because the repairs were more than what the seller needed, or maybe the FHA appraiser called for whatever, it could be whatever reason, and the contract's terminated and you're in that hot FHA first time home buyer market, you may be stuck with that appraisal on that transaction where any other offers made on that house are going to have to you're either going to have to use that appraisal or they're going to have to use different kind of financing that they may or may not qualify for. So be super careful about that. If you're on this buyer or seller side of the transaction, you just need to be aware. Conventional loans have a little bit higher credit score requirements. They are a little bit harder to qualify for, but in a lot of cases, they make a lot more sense. Debt to income ratios are more strict on a conventional loan. And a lot of that's because if someone is putting less than 20% down, you guys have to realize with FHA, mortgage insurance goes with the loan when we underwrite it. With conventional, we approve the loan and then we have to send it to the mortgage insurance company for an approval, and they have their own set of underwriters. I have one loan that we finally, after the 4th mortgage insurance company, got the loan approved. And the reason that we were getting hung up is because the guy had opened up a new bank account, put $10,000 into the bank account 65 days ago. Well, the guidelines are that seasoning is 2 months, 60 days. We approved the file because the $10,000 that the account was opened with is now seasoned. So we can document that we've got a 2-month average balance, we're all good. The mortgage insurance companies did not agree with that. They were making their own overlay underwriting decision. And so again, we had to go to 4 mortgage insurance companies to get an approval. Which brings up another point. Not all mortgage companies have mortgage insurance companies that they have that many relationships with. Same thing with your title companies. Sometimes your title companies like Chicago Title only underwrites for Chicago Title. So if Chicago Title underwriters will not approve an affidavit of heirship, then they don't have any other options that I'm aware of to override that underwrite. Whereas whenever you work with some of our, like for instance, our local title companies all underwrite for, or have different title companies that they have underwriters to go to, just like we do with our mortgage insurance company. So if they don't like the answer from one title company, they can go to another title company as long as they feel strongly about that. And I've had to do that. There's one transaction, I'm not kidding. I checked all over the state of Texas. There is this Texas law that is super quirky. And that quirk is that if someone is purchasing a home or refinancing in Texas, and they don't have a primary residence already in Texas that's homesteaded, you cannot borrow money as a second home or investment property because of our homestead laws. It is the quirkiest thing ever. Everybody will agree that it's the quirkiest thing ever. It's the way the laws were written to protect us from a homestead. And because of those protections, you can't purchase or refinance a non-homestead property if you don't have a homestead in Texas. And in this case, my guy lived in Reno. Of course he didn't have a house in Texas. He worked in Reno, but he had investment property here that he wanted to refinance. And I called title companies all over the state of Texas and found one that would underwrite it. So I say that because mortgage insurance companies are sometimes the same way, and we have to work with mortgage insurance companies on a mortgage loan that has less than 20% down. Down payment requirements, we can do a conventional loan with as little as 3% down. Now, there are some, Freddie Mac has income restrictions on that 3% down. Fannie Mae has first-time home buyer restrictions on that 3% down, or vice versa, one of the two. I can't remember which is first time and which one is income restrictions, but it is an option, and we use that often. We also, most people will do the 5% down conventional loan. The loan limit is $510,000, $300,000 before you go to a jumbo. So just keep that in mind. Any questions on that slide before I move forward? Because that was a ton of information. Nope. All right. So mortgage loans. Now, conventional loans. VA versus FHA. Typically, on a VA or FHA loan, if the automated underwriting system, AUS, does not come back with a favorable answer, and we disagree, and we have documentation as to why we disagree, because the information that the AUS system is reading is incorrect, then some mortgage companies have the ability to override the AUS denial. With a conventional loan, that is very difficult to do. So sometimes we'll go FHA or VA because of that flexibility, and that being our only option. A conventional loan can be used for your owner occupied and second home. Do y'all know how much money down payment you have to have for a second home? Does anybody want to guess the minimum down payment?
10%.
Yay! Alex has it right. 10% is the minimum down payment for a second home. So you can buy a lake property with 10% down and do a conventional loan. Interest rates on a second home in that case are the same as they would be if it was owner occupied. So that's great news too. Now, if you're doing an investment property, then typically it works out best if you're putting at least 25% down. You can do it with as little as 15% down, but because of the way pricing is calculated, they end up paying just as much, almost as much in discount points as they would in the additional down payment just to put the 20% down. So I always recommend the investors, we can always look at that 15% down with mortgage insurance, but typically it works out in their favor to do it as a 20% down, but it better pricing or less closing costs if they do it with 25%. I have invested in real estate for many, many years. I've been buying, selling, flipping, retaining. I've bought businesses. I've bought commercial buildings. I just like real estate. So number one, I'm a really good customer for all of you guys because I just am addicted to real estate. Number two, I can speak the language. So if you guys have an investor that doesn't know, they just, here's their plan, here's their idea, here's their goals, here's their dreams. I can schedule some time, sit down with them and figure out how to make it happen. I may not be the best source of money, but I know where to find the money if you've got some investors that are wanting to put together a portfolio or whatever. That's just kind of, it's fun for me. It's creative work for me. So conventional loans, again, 3% is the minimum down payment. It's typically, I mean, most of the FHA, I mean, the conventional loans we're doing with 5% just because of the income limits with the first time home buyer aspect of it, but know that 3% is available. You know, when someone calls us, I don't know how other mortgage companies handle it, but we always want to know the client's story. So if any of you guys I highly recommend that whatever lender you're working with, that you guys transfer the client's story to the lender. Let the loan officer know this is what their goals are, this is what their dreams are, this is what they would like to accomplish with this transaction, this is their budget. You know, any of that information, hey, they're totally scared, they've never done this before, they really need you to walk them through and explain what's going on, or hey, they've done this 100 times, just throw paperwork at them and they sign it and get it back. Tell your lender that information, because some of the first questions we always ask is, number one, who may we thank for referring you to us? Number two, what did they say about us? And then number three, what's your budget? What's your goal? What have you put together to make this happen? So payment and out-of-pocket expense is the two things that we're looking for so we can figure out what loan program they might be best for. So if you've got someone that is a first-time home buyer and we're automatically going to be thinking, can we make the 3% down payment program work? Escrows, the payments have to include taxes and insurance on a conventional loan if they're putting less than 20% down. An appraisal, you know what, this has actually changed too. We are starting to see a lot of transactions go through where an appraisal is not always required. On a conventional, on an FHA and a VA, an appraisal is required. Now there are some changes that have gone into effect on, due to COVID, where sometimes we can, if it's not safe for the appraiser to come into the home or for the client to be exposed to someone from the outside, there's some exterior only provisions that we can look at on the appraisal side. Mortgage insurance, you guys please know it's not like today I go, okay, what's interest rates today? And I just pull up a chart and see what interest rates are. Interest rates are based on the time of the day, the amount of equity, credit score, type of property, length of the lock, length of the loan, amount of down payment, debt to income. All of that stuff determines the credit score, the interest rate. Same thing with that mortgage insurance. The mortgage insurance premium is factored off of all of that too. So when we're doing a pre-approval, we're doing it based on best case scenario, or we like to do it off a worst case scenario, which we feel is the best case scenario, because if everybody is prepared for these numbers, then they might be pleasantly surprised when we actually get to lock the rate. So Alex, if you have a client that's saying, hey, I'm getting such and such interest rate with so-and-so, then your response should be, did you lock in that rate? Are they allowing you to lock in the loan before we've even found a house? Because if they don't have a lock and shop, which nobody does right now that I'm aware of, we did until COVID, if they haven't locked in the rate, all they're looking at is an estimate. They are not looking at the true interest rate, but they don't know and understand that unless you guys educate them. Interest rates are locked based on all these factors on the exact time that someone says, lock in my rate. So the interest rate is not set even when y'all write those contracts, which is why it's super important, especially with the market being as volatile as it is, that if someone says, yeah, I'm getting 2 3/4% interest rate on this 15-year loan, I would write that contract at 3 or 3 1/4, because you don't know what's going to happen between now and the time they lock the rate. The world could fall apart in the next 2 hours and it drastically changed those interest rates. So don't back your buyers and sellers into corners off of estimates that are, I mean, just bump it up because you don't want to do it based on those estimates. Now, seller concessions can be a little tricky on a conventional loan. So this would be a good slide for you guys to screenshot as well. Plus, we'll make sure that you guys have some handouts that has some good information. But when you are doing 3 or 5, or if you're doing less than 10% down, then the seller can only pay 3% of the sales price or appraised value, whichever is less, towards the buyer's closing cost, taxes, and insurance. The seller still cannot pay this, the buyer's down payment. Now, if the buyer is putting 10%, between 10 and 19% down, it's 6%. And then if they're putting 20% down, the seller could pay all of their closing costs, taxes, and insurance. Okay? So again, concession is anything that's an incentive for the buyer to purchase. Now on loan programs, all loan programs, we have to document income and we have to document assets. So that looks different for different borrowers depending on what their occupancy is and how long they've been in that occupancy. So I would just prepare people for the fact they're buying a house and it's going to require paperwork. And what paperwork is going to be required is specific to them. When someone applies for a mortgage loan, most mortgage companies now are using automated systems to try to verify their income and employment immediately. Same thing with their assets. That's what we do. But if they work for, Totally Addicted downtown Denison, that is not signed up for those automated services because they're expensive and the business is a small business, then we're going to need pay stubs and we're going to need W-2s. If someone is self-employed, we're going to need tax returns. Sometimes we need 1 year, sometimes we need 2 years, depending on how long they've been in the business and how strong they are as a buyer. So just prepare your people for the fact they're buying a house, they're going to need paperwork, and the sooner they get it to us, the more accurate the information that we're going to provide them. We as a company, we as a branch have a policy not to issue a pre-approval letter without income and assets documented, because that will make or break a deal. But not all companies are like that. So I feel that it is very important. We're going to talk about pre-qualification versus pre-approval next week. But I feel that it is very important you pick up the phone, call the lender, whether you're on the buyer side of the transaction or the seller side, get the loan officer or their team on the phone and ask them if they have reviewed their income and their asset documentation in writing. If they have not, ask them to do that and get back to you. Because I don't feel you have a valid pre-approval letter without income and asset documentation. And I would not feel comfortable moving forward with a transaction as a buyer's agent or a seller's agent without verifying that information. I have a very high level of respect for any agent on any transaction that gives me that phone call and asks those questions. I'm like, heck yeah, that's an agent I want to work with because they're looking out for their client's best interest. So you guys do not feel uncomfortable asking those questions. It's very realistic. If you can't get the loan officer on the phone or their team on the phone and you've waited for days for someone to call you back when you're trying to put a contract together, please consider what's going to happen when things might get challenging during that transaction and you need to find them to work out a solution. So you guys be very, very mindful and just know you guys are professionals. You are hired to protect and to represent. So do that. Don't hesitate to make those phone calls and make those decisions. This is all of the documentation that we've got to consider. This is some of the documentation that we have to consider, or the information we have to consider when figuring income calculations. Same thing with our debt calculations. Those are very specific too, and we have to explore, research, and document any and everything on this list, as well as some additional items. This is just an example. So just know and understand pre-approval letters do not get kicked out of the system immediately because all this work has to be done. And if you guys say, well, what if we go, I had this text message last night. We're in the middle of negotiating a contract. I need to switch the loan program up. Can you send me a pre-approval letter for this loan program? No, I cannot. It takes, for us to switch and go from one loan program to the other, we have to totally redo that loan based on the different guidelines. When we as a branch are putting together a pre-approval, we're using Mortgage Coach. I know if any of you guys have done transactions with us, you know what that looks like. It's a comparison, showing them what they're, comparing the payments, the APR, the interest rate, closing cost, now, as well as the future expense or savings over time, so that people can make really solid decisions based on how long they feel like they're going to be in the house, what their break even is going to be. We want people to have options, and we want to advise people as if we were doing the transaction ourselves. So when we're doing that, when we're putting those comparisons together, if I was doing a 3% versus 5% versus an FHA, I got to know all of those 3 loan program guidelines and make sure they qualify for each one of those options that we're putting together. So, but it is only the fair way to give them some options, let them make some decisions, and we'll guide them through that process. This is a really good chart. We'll make sure that you guys have. And then lastly, we got 5 minutes left. I know that was super fast. But lastly, there is another flyer that I would love for you guys to have with every one of your buyers. I can't tell you how many transactions in my career have gone sideways over buyers, us assuming, and buyers not listening when we tell them, do not go save 10% at Lowe's this weekend because they're having a 4th of July sale to go buy a refrigerator, washer, and dryer. Because it will happen. And I'm telling you right now, before every holiday where you see all of these furniture sales and appliance sales, if you have a transaction going on, do yourself a favor and send them a text message or make a phone call and say, hey, listen, I know you may be tempted to go save some money, but do not open up a new account. Don't charge on anything. Don't purchase anything. Don't use your money, because it could mess up the transaction. So every holiday, that should be your go-to to make sure that you don't have anything that comes up at the last minute that kills your deal. So we are going to pull a credit report 5 days prior to that transaction closing, and we're going to verify the employment. We're going to verify the income one last time. So it's not like we're not going to see these transactions. So I'll make sure you guys have it. All of these handouts so that they are helpful. You guys keep my cell number in your phone for you guys to use as your 911 hotline Q&A. And then, but if you have a referral for us, then that needs to go to our team so that they can get on it right away. We have a very specific system on how we make sure that we do a great job for you. We edify you as the agent. We have an email template that we really advise you to use, which creates that triangle of trust so the customer feels comfortable with us. We get the client story so that we understand how it's best to serve them. And it just makes that whole process go a lot smoother. Our goal is to get them pre-approved as quickly as possible while they're emotionally vested, so that you can get them under contract as quickly as possible, and then we get that deal closed as soon as we can. So does anybody have any questions? Are y'all's mind blown? And who wants to be in the mortgage business?
I have a couple questions.
Yes.
Real quick. Let's say a retired couple, they're downsizing. They have a home paid off. They want to buy a smaller home first and then pay off their loan right after they sell their house. Is there a penalty for paying off a loan within a year?
Well, so the correct answer is no, there is not a penalty to them. There is a penalty to me if they pay off before they make their 6th mortgage payment. But I can't morally say, or I can't ethically say, no, you can't do that. However, I am greatly penalized. So I would appreciate the heads up if you know that's happening. Because what I'm going to do is I'm just going to call a couple of my buddies at the bank and say, hey, I need to borrow a little bit of money. They're going to pay it off when their house sells. Can you hook them up?
Yeah.
So I just need the heads up in that situation so I don't get into a situation that costs me a lot of money later and then cost the company to ask me what in the heck I'm doing, why I'm giving temporary loans out whenever that's not what we're set up to do. And it's only because it's just super expensive from a mortgage company standpoint. And so, of course, every business has its return on its investment, and a loan paying off in 2 months is not the return on the investment that we are set up for. So.
Right. Oh, that makes sense. And then mortgage points, is that something a seller, can that be a seller concession?
Yes, it can. And that's a fantastic question. I was going to cover that just a little bit ago. Yes, the seller can buy those points down. You guys, I would love to do a training one of these days for you guys on the 3-2-1 buy downs. It doesn't make a whole lot of sense right now, but there, you know, if we've got too much concessions, more than what the costs are, a lot of times we'll suggest that we use that money to buy the points down even further.
Cool.
The other thing that I wanted to bring up, Alex, that you just reminded me whenever you said that. Now, one thing that we do a lot of, and I've got someone that may pop on this call in just a few minutes that I'm supposed to meet with in a few minutes. But if someone in that situation, you got this retired couple, they're going to downsize, and they've got equity in their home, but not enough to pay the loan off in full, the new home off in full. But they don't want this big payment forever. They're not comfortable with it. They can say they had $50,000 to apply towards this $150,000 house. Once their house sells, we can take a principal reduction and then refigure their payments based on that new loan balance. Not everybody can recast immediately that way, so don't make assumptions. There are times where even if they had to buy the house with 5% down and get mortgage insurance, that we can work with them to help them get the mortgage insurance removed. BJ is a wizard at all of that backing stuff. And so we are very fortunate and blessed to have her in our branch. She knows and understands escrows really well. She has our customer service in her hip pocket. So those are all scenarios where if I know what the customer's goal is, we'll figure out how to set it up so that it's successful short-term and long-term. All right. All right, cool. You guys are totally amazing. Rock out this day. Let me know what we can do to help you, and we'll get everything processed for your CE. I saw everybody on camera, I think, that was doing this for CE, so we'll be sure to get that registered. Rochelle's keeping notes. All right. Y'all, thank you.